Good morning everyone, thank you very much for joining us on today's video. Today we would like to do a brief preview of the US Q2 earnings season. Q2 earnings season in the US has begun. Now so far we've had a very small number of companies report, only 28 out of the 500 in the US S&P 500 index. However, there are some individual company names that we would like to cover off in the session today. So what typically happens with US earnings is that we see the financial sector report first, and that's been no different in this quarter's earnings season. So we've had names such as BlackRock, Citibank, JP Morgan and Wells Fargo report earnings so far, and JP Morgan's really the one we would like to focus in on in today's video. JP Morgan, as you will know, got involved when we saw the US regional banking crisis and actually took over First Republic Bank during that time period. Now, at the time, many investors might have thought that this would be detrimental to JP Morgan, but what we've actually seen is JPM report better than expected earnings numbers, partly down to the acquisition from First Republic Bank and the impact that that's had on their net interest income. More financial companies are expected to report their earnings throughout the rest of this week, so we'll provide any updates that we think are necessary in the videos over the coming weeks. Now, thinking broadly in terms of what markets are expecting for this season's earnings, we're seeing that analysts are expecting higher costs to come through. Now, that's driven by a few different factors. We're seeing higher input costs coming in the form of things like materials, but also wages and labour are a factor there. We're also seeing the impact of higher interest rates coming through for companies. That is on top of revenues, which are expected to be flat, which means that we're seeing contracted or falling margins on flat revenues, which results in that lower growth. However, what we would caveat that with is that the market is then expecting earnings to then pick up in Q3 and Q4 of 2023, as well as seeing positive growth in 2024 as a whole. Things that we're thinking about as an investment team, once again, we've mentioned margins, so are companies able to either reduce cost base or pass on costs to customers? So we'll see that come through in terms of higher revenue. Want to see what companies are reporting in terms of labour. Are they looking to reduce labour, add labour? What are they seeing in terms of labour costs? So are we seeing that pressure that we've seen in terms of wages? What we're also interested in seeing as well is in that demand side. So are we still seeing the robust demand that we've seen so far from consumers playing through into those earning numbers? One thing that we think is worth mentioning in terms of a longer term picture is just the impact of the US dollar. So if we think back to last year, Q2, Q3 of 2022, we saw a lot of corporates coming out mentioning that the headwind that a higher US dollar was having when it was translating foreign earning or foreign revenues back into the US dollar was having, just given the strength that we'd seen, meaning that translation effect was a headwind. What we've seen so far in the past couple of weeks is the strength of the US dollar weakened. So you've heard us talk about that Dixie index, and that's below a level of 100 for the first time in about a year. So if we see that US dollar weakness sustained for a longer period, come Q3, Q4, a theme that we might start to see from US corporates is that headwind now turning into a tailwind and being positive for their earnings. So thanks for watching. We'll keep you updated on US earnings as they come through, and we'll catch you on tomorrow's video.